Okay, this video covers disclosures about stockholders' equity. So we're going to use FactSet as our example company again. We're going to talk about their stockholders' equity disclosures and what we can learn about their equity account using their financial statements. But first, what I'm going to do is go through some definitions. And so this slide is just some definitions. And first, I want to talk about what is the top account that you'll typically see in the stockholders' equity section of the balance sheet. The first account you will typically see is just going to be called common stock. And that common stock account just relates to the par value of the common shares that have been issued by the company. And within the common stock label on the balance sheet, you'll typically have quite a long line there where certain numbers are going to be disclosed. And the first number that a company will typically tell you about is the par value of their common stock. And this is an essentially pretty meaningless number, but what does it mean? The par value is just stated in the charter, and it represents some baseline value of a share of the company's common stock. So it actually doesn't have any significant economic meaning. It's just the par value. And the idea in accounting for equity is that the par value of common stock will go in the common stock account. And anything above par that the company receives as an equity investment will go into an account called additional paid-in capital. Okay, so that's the par value, and it'll be stated as of per share. So each share has a certain par value, and all shares have the same par value. Okay, next what you'll see is the number of authorized shares. And authorized means that within the company's articles of incorporation, so this is kind of the agreement of the baseline agreement of the corporation that all the shareholders agree to. The articles of incorporation will state that the company is authorized to issue a certain number of shares. If the company wants to issue more shares, they would need to authorize more shares in the articles of incorporation. So that's what the word authorized means. It just means that the company has the ability to issue this total amount of shares. Next, issued shares means that at some point, those authorized shares have been transferred to an external shareholder. So out of the total number of authorized shares, how many total shares have you transferred to an external shareholder? The next line item is outstanding shares, and this is the last one. Outstanding shares means that the share has been issued and it remains in the possession of an external shareholder, okay? So sometimes a company will issue shares, but then subsequently repurchase those shares into treasury. So those shares would be issued, but no longer outstanding, okay? Great. So next, the additional paid-in capital account, and this is kind of a catch-all account in the equity section of the balance sheet. And generally, what additional paid-in capital represents is the amount of equity financing that the company's received, so cash from external shareholders that the company has received in excess of the par value of that stock. And so we call that the additional paid-in capital account. The treasury stock account represents shares that are issued but that are not currently outstanding. So the company at one point in time issued those shares to an external shareholder, but then subsequently repurchased the shares into the company's treasury account. And so that's what this treasury balance represents. And typically equity balances have credit balances. This treasury account has a debit balance because it represents shares that have been repurchased by the company. And so the balance of the treasury stock account, well, the number of shares in the treasury stock account is equal to the difference between the number of shares that have been issued and the number of shares that are still outstanding, okay? And this, by the way, this treasury account represents the cost of the shares that have been repurchased. So the cost is the amount of cash that the company paid to repurchase those shares. So the journal entry, to repurchase shares would be a credit to cash and a debit to treasury stock. So this treasury stock is holding a debit balance. Next, the accumulated other comprehensive income account will be in the equity section. And we've talked about this once during the semester when we talked about available for sale debt investments and the changes in the fair value of available for sale debt investments. Rather than putting those changes in fair value into net income, we accumulate those changes in AOCI, okay? So this AOCI account just reflects the cumulative total of all the changes in stockholders' equity other than from transactions from owners, so transactions with owners those affect the accounts above here: common stock, additional paid-in capital, and treasury stock. And then transactions reflected in net income, as you know, those transactions are reflected in retained earnings. Okay, so other than those two types of transactions, anything else, and it's just a specific types of transactions that are accumulated in AOCI. Okay, finally, the retained earnings account. So we've been working with this quite a lot during the semester. The retained earnings account just represents the cumulative net income of the company minus the cumulative dividends declared by the company. Okay, that's the retained earnings balance. And some companies will call this an accumulated deficit if they've had a life-to-date net loss. Then it'll be a negative balance. It'll be a debit balance in retained earnings. And so they'll switch the label, and it's sometimes known as accumulated deficit if it's been a life-to-date loss by the company. Okay, so these are the definitions. Next, we'll actually look at the financial statements. So here's the balance sheet of FactSet as of August 31st, 2019. So we see that they don't have, here the first one is preferred stock. So it has a par value, an amount of shares authorized, but none of these shares have been issued. And so this account balance is 0. Next, the common stock account, it tells you a 1 penny par value. 150 million shares have been authorized by the company, but only 40.1 million shares have been issued. Okay, so the company has transferred to shareholders a total of 40.1 million. And then as far as outstanding is 38.1 million shares continue to be outstanding. So in terms of how many shares are out there in the marketplace trading right now, it's only 38.1 million shares. So when we talk about the total market value of a company's equity, the market value is based on the number of shares outstanding. And so it's this $38.1 million number of shares outstanding. You would multiply that by the price per share that you see in the market, and that's what's known as the market value of the company's equity. Sometimes they'll call that the market capitalization of a company, or the market cap. Okay, so we've got shares that are authorized, shares that are issued, and shares that are outstanding. Next, we have the additional paid-in capital account. Remember, this is all of the it's a catch-all account, but it generally reflects the amount of cash received from external investors in return for ownership over and above the par value. Okay, so you can see this par value. What number is that representing? The par value is the number of shares issued, 40.1 million, times a penny per share. Okay, so the common stock account is holding $401,000. And then the additional paid-in capital is holding whatever over and above that amount the company received from external shareholders' investment in return for an ownership interest. Next, the treasury stock account. So you'll see this is a negative balance. That's because it's a debit balance. And you can see that the company has repurchased $1.9 million of treasury shares that they're holding as of August 31st, 2019. And this 1.9 million is equal to the difference between the shares authorized and the shares outstanding. So the difference between 38.1 and 40.1. That's essentially this $1.986 million shares, sorry. Okay, then next there's the retained earnings account, which is holding a credit balance, and AOCI, which is holding a debit balance. So if their AOCI represents the changes in fair value of available for sale debt securities, what I'm interpreting here is that they've had a holding period loss that they haven't yet recognized into net income. So if this represents changes in fair value available for sale debt securities, if they were to sell those debt securities, they would transfer this holding period loss into the income statement whenever they make that sale. So that's the balance sheet. Now let's move on to the next place. We'll see and I'm just showing you everywhere on the financial statements where you'll see equity transactions appear. So here in the cash flow from financing activities section of the cash flow statement, you'll see that the company made some dividend payments during 2019. Okay, so these cash payments are reflected in the cash flow statement. They also did repurchase of common stock of $220,000. Okay, actually $220 million is what they paid for a repurchase in common stock. So remember that number, $220 million repurchase of common stock. Now let me go back to the balance sheet and show you that the treasury stock account increased by essentially that number. Okay, that's why that treasury stock balance increased. It was a debit to treasury stock and a credit to cash. So what you're seeing on the cash flow statement is that credit to cash. Okay. Also, the company had some proceeds from their employees' stock plans. So FactSet gives their employees the opportunity to purchase stock, whether it's through stock options or some other program. Employees can purchase stock and usually at a discounted price. So when companies make those purchases, they're actually giving cash to FactSet in return for those shares. So this is a cash inflow. Okay, great. So that's the financing section of the cash flow statement. Next, just in the operating section of the cash flow statement, what will we see? Well, typically the only thing you'll see here is an add back for stock-based compensation expense. And so companies record stock-based compensation expense for the estimated fair value of the stock that they're compensating their employees with, or options that they're compensating their employees with. It's an expense that reduces net income. So it reduces this number here, net income. Well, to compute cash flow from operations, we have to add that back because it's a non-cash expense. And so this 32,400 is adding back stock compensation expense to arrive at operating cash flow. Okay, the next thing we'll go to is the statement of stockholders' equity. And what this statement does is it shows you, these are all of the stockholder equity accounts on the balance sheet. Okay, they're listed across the top. And what this statement does is it rolls forward this balance from the end of last year to the end of this year. And so it just shows you how these balances went from their beginning of year balance to their ending of year balance. So you'll see in terms of common stock, okay, the company issued some common stock for those employee stock plans. And then some employees earned some restricted stock. So restricted stock vested and it became owned by some employees. Okay, so these are the two issuances of common stock during the period. If you look at additional paid-in capital, so when the company received cash from its employees, it increased this additional paid-in capital account. You also increase additional paid-in capital when you recognize stock-based compensation expense. Okay, so you debit the expense and you credit additional paid-in capital. So here's that credit here to additional paid-in capital for stock-based compensation expense. Then in terms of treasury stock, okay, the company, when they issued restricted stock, they did some repurchases from the market just to soften the diluting effect of compensating their employees with stock. So they repurchased some stock in relation to the vesting of the restricted stock. And then they also did another repurchase. Okay, so if you sum these two numbers here, this is the total amount of repurchases that the company did during the year. And that adds up to the 220. Okay, next, what we'll look at is just retained earnings. So their retained earnings balance had a beginning credit balance. It increased with net income, and then it decreased with dividends declared. Okay, and you can kind of ignore these cumulative effect of an accounting standard change. You can just ignore that for now. And finally, the AOCI balance, okay, they had some changes to that account during the period. So that's what this statement does, is it explains how all the stockholder equity accounts on the balance sheet went from their beginning of year balances to their end of year balances. And that's it. That's all the disclosure I wanted to go through with you in terms of stockholders' equity. I hope this has been helpful, and I'll see you later. Bye-bye.